Good morning and welcome to the Killik & Co market update. At the time of recording, it's been a relatively quiet week for financial markets as we head towards the end of the summer. Equity markets have continued their grind higher, with a number of major indices hitting fresh all-time highs in recent days, including the S&P 500, the Dow Jones Industrial Average and the MSCI World Index. Concerns around the ongoing COVID-19 pandemic, the risk of rising inflation and the potential tapering by the US Federal Reserve have been shrugged off as companies in aggregate have beaten both consensus revenues and earnings estimates during the current reporting season. According to data by Bloomberg, of the 483 S&P 500 companies to have reported so far, 83% have beaten consensus sales estimates and 86% have beaten earnings estimates, with sales on average 5% ahead of expectations and earnings 16% ahead of expectations, which have led, in turn, to earnings upgrades for future years. If we dive a little deeper into the performance of equity markets and examine the performance of the various sectors that make up the overall market, we find an interesting contrast to the makeup of returns so far this year compared with 2020. The following chart shows the performance of the 11 sectors of the MSCI World Index, both year to date in green and over the entirety of 2020 in pink. The first thing you might notice is that every sector has made positive returns so far in 2021, and that some of the strongest sectors, including financials, real estate and energy, were amongst the weakest performers in 2020. Another thing is a relative dispersion of returns. Whereas each sector has contributed positive returns so far this year, the COVID-19 pandemic created a real environment of winners and losers in 2020, with some sectors such as tech posting very strong positive returns, while others such as energy found themselves heavily underwater. If we look back over the last decade, then what we find is that this year's narrower dispersion of returns is relatively normal. This chart shows a standard deviation of sector returns during the first 8 months of each year from 2012 to 2021, and you can see that 2020 was a huge outlier, with a standard deviation in the high teens. In contrast, the dispersion of returns so far this year is in line with the 6 to 8 range that most previous years have fallen into. One subsector that has been in focus recently is luxury goods. The industry has recovered remarkably well from the COVID pandemic, given its origins in China, the sector's most important market, and the ongoing restrictions on international travel, an avenue through which a significant portion of luxury spending is done. The sector's resilience has been given a new test over the last few weeks as news emerged that the Chinese Premier had called for stronger regulation of high incomes at a meeting of the Communist Party's Central Financial and Economic Affairs Commission. The details of what such regulation might look like are currently thin on the ground, but may involve higher personal and corporation tax in an attempt to create a more equal Chinese society. On the face of things, this appears to be a significant risk to the sector, with Chinese consumers accounting for 35% of the total value of luxury goods sold in 2019, according to consultancy Bain & Co. And the share price of companies operating in the sector declined sharply last week as news of Xi's speech emerged. Here you can see a chart of the share price performance of LVMH, the industry's largest company, and how the shares have pulled back recently, following what has been a strong run over the last 2 years. However, to the extent that any new regulation and taxation are targeted at the very top end of Chinese society, the impact on the sector might not be as severe as such share price declines might indicate. While China, according to a study by the IMF, is one of the more economically unequal countries in the world, this inequality, as you can see in this chart, has actually been declining since its peak in 2008, according to the Gini index. This decline has been driven by gains for the middle income distribution, an important demographic for the luxury sector, and has coincided with continued growth in luxury spending by Chinese consumers. Therefore, it's not clear that efforts to address economic inequality in the country would have a negative impact on the demand for luxury goods, particularly if prioritising a common prosperity for all, as has been reported, were to bring greater numbers into the middle class. Moving on to the week ahead, earnings season continues to wind down, so it's another quiet week from a reporting perspective. But we will see results from video conferencing business soon, from Costco, who are due to release their August sales numbers, and from cybersecurity company CrowdStrike. That's it from me. Have a great weekend, and we'll be back next Friday.